Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. The channel continues to grow because of people like you. And if you are stopping by for the first time and you are a dividend growth investor, go ahead and hit that subscribe button down below. Hit the notification bell so you're notified whenever we post any new content. Join us on our journey to financial freedom. Hopefully you're on your own journey as well. Join the vested interest community, building a community of like-minded dividend growth investors. So I can share videos exactly like this. We are going to take a look at 5 stocks to buy in December. Kroger, CVS, Proctor Gamble, Nutrien, and Cisco will be the 5 that I am really going to focus on for December. Are you a dividend growth investor? Let me know what stocks you are going to be focusing on for the month of December. Let's jump right in and take a look at why I am going to be looking at these particular ones. So this is the vested interest stock screener. You can pause this. This is how I look at a company on a high level. It is also how I look at and set up my stock pick of the day videos. So if you are interested in that type of content where we take a company's stock and we look at one that's pulled back on the day, Monday through Thursday, and see if it is presenting any value, we do a little bit of a high level running through these criteria, understand the business. So that's where we'll start. We'll look at the business itself, growing free cash flow over the last 5 years and expected in the future, growing dividend payout ratio of 75% or less. We check the valuation based on dividend yield theory, buy below current cost basis or within 15% of its 52-week low. That's whenever we want to initiate a new position. Return on invested capital or return on equity equal to or greater to the industry average or 10% plus. I really focus on the 10% plus. Earnings per share growth equal or greater than the industry average or 5% plus. I focus more on the 5% plus, but again, some don't meet that, so compare them to what other companies are in their industry. And for companies like banks, we throw in price to book, 1 being fair value, anything under 1 being potentially undervalued, anything over 1 potentially overvalued, and must meet 5 of 8 if it's not a financial company. If it is a financial company like a bank, it must meet 6 of 9. Now, first up on our list, we are going to take a look at Procter & Gamble. This is an existing position within my portfolio. I have 28.706 shares here. You can see I am up a little bit on this one. I am willing to buy this up to 155 per share. So it is getting a little up there. I'd really like it to pull back into the 149, 150, or even lower range, but it's just one of those stocks that always seems to be trading at a premium. But you can see here it's 52-week range, $135.83 low, $158.38 high, definitely closer to its 52-week high. But again, I am okay on this one up to 155 per share. You can see here they estimate it being overvalued slightly, about 16% overvalued is their estimate, at least according to Yahoo Finance. They have a market cap of $358.931 billion, a beta of 0.46, so they are less volatile than the overall market. As of the close of business on Tuesday, whenever I recorded this, $152.29. They were up slightly on that day. PE ratio 24.72. It is a little higher than I like, but again, this company just always seems to be trading at a premium. I would like it down in the 140s and under range. My cost basis is 139, so I am bringing my cost basis up a little bit on this one, buying it up here, and I probably won't let it go much over 146, 147 as far as my cost basis. So I'd like to add another maybe 10 shares here. Earnings date, January 23rd, so coming up the first of the year here, next year, which is crazy to think. Next year is just around the corner. Forward dividend, $3.76. They are a quarterly payer. Divide by 4. Their yield is at 2.49%. Ex-dividend date was October 19th. They paid out on November 15th. Kudos to the people who are holders of this. I received my dividends on November 15th. We'll see that in the upcoming video, the dividends and options that I was paid out for November. So look for that video coming up. 1-year target estimate, $165.35. So according to Yahoo Finance, they see some potential upside on this one. Now, according to dividend yield theory, 5-year dividend yield average 2.49. It's just a hair above that at 2.49%, 2.48. I mean, at 2.49% is where it currently sits. So just slightly undervalued. We're going to call it fair valued. According to dividend yield theory, payout ratio under the 75% I'm looking for at 60.19. So it has plenty of room to pay down debt, to increase the dividend, to make acquisitions, to make reinvestments back into the company. Return on equity, I like 10% or better, and return on invested capital, same thing, 10% or better. And this return on equity for Procter & Gamble sitting at 32.9%, smokes the 10% I'm looking for, and the return on invested capital 18.06, same thing, much higher than the 10% I'm looking for. Earnings per share growth sitting at 7.54%, beats the 5% that we're looking for, and it is forecasted to grow its revenue at 4.48% over the next 5 years. Free cash flow here we're going to look at. We want growing free cash flow because we want dividends to grow over time. So 2020, $14.3 billion, up in 2021 to $15.5 billion. Looks like a bit of a drop in 2022 to $13.5 billion, but right back up so far in 2023 to 13.7, and actually to date 14.5. So overall, we are seeing growing free cash flow, and this is another thing to really focus on that I really like about this company. They are aggressively buying back shares. 7.4 million here, 11 million here, 10 million here, 7 million, and so far, again, throughout this year, if you added these two together, you'd be 11 million if that's where they're at. So love that they're buying back shares. Love the numbers overall. Would like them to pull back a little bit, but again, I'll run this up, probably buy up to 155. Anything over 155 is getting a little rich for me, and I don't want to run my cost basis up much more than 146. So I'd probably add another 10 to 12 shares here. I don't know if I'll get all that in the next month, but I would like to get the $6,000-$7,000 invested in this one and get this up to over 30 shares anyway. All right, Procter & Gamble, that's number one. Number two, we are looking at Nutrien, ticker NT, and I'm sorry if I didn't mention it, Procter & Gamble, ticker PG, is out of the consumer staple sector. Nutrien, ticker NTR, is out of the material sector, sitting at $55.41. Again, all of these as of the recording on Tuesday evening. 52-week range as low as $52.23, as high as $85.16. So this one is closer to its 52-week low. They project it to be 136% undervalued. I don't know if I buy that, but I do like to see that. We'll see this. I don't really pay attention to this. As you saw on the last slide, all of them were pointing up, that they think Procter & Gamble is going to be going up. Here they think they see a bearish pattern. I'm not a day trader. I think this is more for day traders, but I wouldn't mind this pulling back overall. So not really upset about that if it does pull back a little bit, so I can get this at a cheaper price. Market cap of $27.403 billion, a beta of 1.01. They are more volatile than the overall market just by a hair. Price to earnings ratio is low at $12.59 per share. Earnings per share sitting at $4.40 per share. Earnings date coming up February 13th through February 19th in 2024. Again, can't believe it's already almost 2024. For dividend, $2.12 paid out in the year. They are a quarterly payer. Divide by 4 there. Nice dividend yield on this one, 3.85%. Ex-dividend date, December 28th. They are going to pay out on January 12th. So if you were to buy them now, you would be in line for their next dividend. And a one-year target estimate, at least according to Yahoo Finance, $73.23. So they see some upside on this one. Let's look at dividend yield theory. Again, we're going to go down, look at their 5-year dividend average, 3.27. It's currently sitting at 3.85. So according to dividend yield theory, they are potentially undervalued. Low payout ratio on this one, 47.05%. Much lower than the 75% that I look for. So they have a lot of room to increase that dividend with a nice starting dividend yield as well as a low payout ratio. Good combination here. Return on equity, again, we like 10% or better. Unfortunately, this does not quite meet this, but if you were to compare this to like a Mosaic, ticker MOS, which is in the same sector, you would see it's right in line with where it needs to be. Return on equity, 8.7%. Return on invested capital, 6.08%. Neither one of them meet that 10% threshold, but they are in line with their industry average. Now, this is one of the negatives on this one. EPS growth is forecasted to be negative over the next 5 years, negative 22.64%. as well as negative revenue growth, negative 1.89%. That is not good to see. I'm hoping that they are wrong. But again, if you were to compare them to Mosaic numbers are very similar. They are projected to have decreasing earnings per share and revenue growth over the next 5 years. Now over to free cash flow, 2019, 1.7 million, 2020, 1.7. So almost right on the nose number. They are right on the nose, exactly the same. So that's not very typical there. The only difference being the repurchase of shares, a lot more shares repurchased in 2009 than 2020. So a drop in free cash flow in 2020. 2021, they were back up to 2.1 billion and repurchasing shares. 2022 up to 5.6. So a big jump up into 2022, and that might be part of the reason they're forecasting EPS and revenue growth to drop down. With a big jump up like this in 2022, that's abnormal for a company like this. Usually you see slower growth. So it may have had a year of significant outperformance, and they're expecting it to return to the mean. So I would not. And then 2023, looking back at 2.8 billion, right? So far here in 2023, it looks like they're more in line with where they were 2019, 2020, 2021. So that's probably part of this negative. Again, another one that I am long on. I have 126.88 shares. My cost basis is $59.45. So anything I buy under that is bringing my cost basis down. That's part of the reason I want to add to this one. I like this company. This is a Canadian company, so there are some tax implications on this one. If you are interested, make sure you understand those tax implications. But Nutrien is number 2. Let's keep rolling here. Number 3, Cisco Corporation, ticker SYY. This is also out of the consumer staple sector. Actually, 3 of the 5 you're going to notice are out of the consumer staple sector this month. And I'm seeing a lot of value in the consumer staple sector right now. So that's part of the reason for this as well. $71.83. Looks like they were down at the close of business on Tuesday. They say a little under fair value, negative 3-point estimated return. So that means they're a little overvalued. At least they think so. Yahoo Finance does. 52-week range as low as $62.24, as high as $87.21. This one has run up a little bit. This is a recent addition to the portfolio. I added it a couple months back, sitting at 75 shares. I am up 7.88%. As you can see, I was buying it back here in the mid to low 60s. So my cost basis is $66.59. It's another one that as I buy this, it's going to bring my cost basis up. So I probably won't let it run up much more than $70, $71, about where it's at right now, before I'd back off. I'm really trying to get this to about 100 shares and then probably back off is what I'm realistically looking at on this one. Excuse me. Excuse me. Market cap of $36.229 billion, a beta of 1.12, so they are more volatile than the overall market. Price to earnings PE ratio sitting at $20.23 per share. Earnings per share sitting at $3.55 per share. Earnings date coming up January 29th to February 2nd. Forward dividend, $2. They are a quarterly payer, divide by 4, so basically 50 cents per share. Nice dividend yield, 2.78%. Ex-dividend date January 4th. They're going to pay out on the 26th, so you would be in line for the next dividend if you were to start buying them now or own them now. And a one-year target estimate, at least according to Yahoo Finance, is $76.69. Let's jump over and look at dividend yield theory. Their 5-year dividend yield average is 2.44%, currently sitting at 2.78, right? 2.78, same number. And to find dividends and splits and the dividend yield theory, you go into statistics, go down to dividends and splits. That's how I'm looking this up. It's in this, right, statistics tab, and then the financials is down here covering free cash flow. And forward annual dividend sitting at 2.78. So since it is higher than their 5-year average, again, according to dividend yield theory, speaks to some potential undervaluation. Another one with the low payout ratio, 55.77%. So they have a lot of room to increase the dividend yield, pay down debt, make acquisitions, reinvest back into the company. All good to see. Return on equity on this one, 101.2%. Smokes at 10% I'm looking for. Return on invested capital, 17.27%. Again, much higher than the 10% I'm looking for. Very nice forecasted earnings per share growth, 12.06%. Again, I'm looking for 5%. And revenue forecasted growth at 4.55%. Very nice numbers overall. Really like this company. Again, trying to get it to about 100 shares, then back off. Let's look to, and then just nibble, a couple shares. I'll probably do 10 to 15 shares at a time, tranches, till I get it to 100 shares. And then, like I said, back off wherever it's at. 2020 free cash flow, $898 million. 2021 up to $1.4 billion. Big jump up. 2022, bit of a drop to $1.1 billion. But you notice here, repurchase of shares, none in 2021. Back at it in 2022. 2023, $2 billion, just a little over. More repurchase of shares. And then so far, again, to date, 1.9. So overall, from 2020 to current, or growing free cash flow from the $898 million back here in 2020. So very nice numbers overall on Cisco. Number 4, CVS Health Corporation, ticker CVS. This is out of the healthcare sector. $69.32 as of the close of business on Tuesday. 52-week range, $64.41, as low as $64.41, as high as $104.83. Closer to its 52-week low than its 52-week high. They see it undervalued significantly, so 64% estimated return, so 64% estimated undervalue here. Again, you can take a look at this for you traders out there. They see a bearish pattern, short term going up, mid-term going down, long-term going down. So they see some more downside in this one in the long term here. Again, I don't mind that. I'm in this for the long haul, so I don't mind the ups and downs so long as 10 years from now it's not, lower than where I bought it. Market cap of $89.20 billion. Beta of 0.56, so another one that's less volatile than the overall market. Price to earnings ratio sitting at $10.62. That's low for a company like this. Earnings per share sitting at $6.53. That's nice for this company. Earnings date, February 6th through February 12th. Forward dividend is $2.42. Another quarterly payer here. Divide by 3.52% dividend yield. Nice starting dividend yield on this. Ex-dividend date was October 19th. They paid out on the 31st. And one-year target estimate, at least according to Yahoo Finance, of $86.82. So they see some significant upside on this one over the next year. Now let's look over at dividend yield theory again. 5-year dividend yield average 2.85, currently sitting at 3.52, significantly undervalued according to dividend yield theory on this one. Payout ratio very low, 36.22%. A lot of room to increase their runway, increase those dividends. Buy back shares, they are doing that recently. They hadn't been, but they are doing that recently. Pay down debt and reinvest in the company if they want. Return on equity sitting at 11.9% is above the 10% I like. Return on invested capital, not quite there at 6.74%. But companies like this, you'll see Kroger coming up here in a minute, are usually capital intensive, and they do not have great numbers when it comes to return on equity and return on invested capital. This is actually a very good return on equity for a company like this, and a very decent return on invested capital. And EPS growth, look at this. 5% is what I look for, 29.75. So there you go. Nutrien was in the negative, but CVS more than makes up for it. How does that work? Revenue growth forecast sitting at 4.64%. Looking at free cash flow, going back to 2019, and define free cash flow. Again, you go into financials, you'll find it there. 2019, $10.3 billion. 2020, $13.4. Jump up in 2021 again to 15.7. 2022, it looks like a drop down, but look at this, 13.4 billion, just under that 15.7. But then they repurchased a huge amount of their own shares, 3.5 million shares here. Free cash flow so far to date, 11.3. Looks like they're going to be pretty close to those 2022 numbers and repurchasing more shares than they did last year. So overall, growing free cash flow on this one. Very nice growing free cash flow. I am long 134.016 shares. $70.09 is my cost basis. So again, if I'm buying at anything under than that, I'm bringing my cost basis down. I would like to run this up to maybe 150 shares. Again, I don't know that I'll get there all this month, but that's probably about where I'd back off on this one. CVS. Now, last but certainly not least, the newest position in the portfolio, we are talking about Kroger, ticker KR, another one out of the consumer staples sector. $43.92 as of the close of business on Friday. 52-week range as low as $42.10, as high as $50.41. So right up against their 52-week low. I'd like them to even bust through that 52-week low and drop back into the 30s. That's what it's kind of showing here in this bearish pattern, short-term, mid-term, long-term, that they see it going down. Wouldn't bother me if it dropped back into the 30s, especially since I just added it in, 10 shares, right? $42.96. I'm up 2.22% shares, so I really want to keep it as close to this 52-week low or a little under and decrease this cost basis, not start screaming up the ladder, so to speak. They see it being near fair value, -5 estimated return, so I don't mind paying fair value for a good company. I think Kroger is a good company. Market cap $31.592 billion, a beta of 0.5, so another one that is less volatile than the overall market. Price to earnings ratio sitting at $19.61. Earnings per share sitting at 2.24. Next earnings date coming up November 30th. That should be the end of this week here. Forward dividend, $1.16. Divide by 4. They are a quarterly payer. 2.63% dividend yield. Ex-dividend date, November 14th. They're going to pay out on December 1st, so they'll be paying out Friday. I will not get that. I don't believe I bought this position before that, so I will not get any dividends on that one. Excuse me. 1-year target estimate, at least according to Yahoo Finance, $50.16. So see some upside on this one. According to dividend yield theory, 5-year dividend average 2.02%. Forward dividend yield 2.63. So undervalued according to dividend yield theory. Return on invested capital sitting at 15.7%. Is above the 10% I'm looking for. And there you go. Look at that. Same return on invested capital we saw for CVS at 6.48. So very close. And this is, again, these type of retail companies like this, supermarkets do not have very huge margins, do not really typically have great return on equity and return on invested capital. So these are actually really, really good numbers for a company like this. Earnings per share growth, I like 5%. They're at 12.51. Smoking, that's great for a company like this. Revenue growth, 2.07%. Good numbers overall. Love the company. Really want to run this up to about 100 shares. I have 10 currently. Cost base is $42.96. Again, it's starting to run up. I'm hoping that it stays down here, at least under 44 is where I'd really like to be picking this up, but I wouldn't mind it dropping back in the high 30s. Let's look at free cash flow. 2020, $1.5 billion. 2021, $3.9, big jump up. 2022 sitting at 3.5. 2023 so far, at least to date, $2.8 billion. So it looks like they're going to be in line with, or pretty close to in line with 2021, but also repurchasing. 2021 was a huge year for repurchasing shares. 2022 as well. Looks like they're going to have a banner year in 2023 also. So very good numbers overall. Growing free cash flow there as well. Now, those are not the only companies that I am seeing that are fairly, or in my opinion, great deals right now. Pfizer is another one out of the healthcare sector, ticker PFE. Johnson & Johnson, ticker J&J, is another one. Enbridge, this is out of a Canadian company as well, out of the energy sector. Realty Income, still undervalued in my opinion. Bank of America and Kraft Heinz. There's a few others out there. Smucker's, I think, looks attractive right now. Spartan Nash, which is another grocery store similar to Kroger's. They are more in line with the military. That would be another one. There are some screaming deals out there, folks. Make sure that you're getting out in the market and doing some research. A lot of good buys right now. Take advantage of it while you can. And that is really it for this one. What are you watching for the month of December? I mean, can you believe it's December already? 2024 is really just a blink away. Right? It just really is crazy. Well, let me know in the comment section down below what you're buying for the month of December, what you'll be watching. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Help me grow this channel. Help me get the word out. Dividend growth investing is the best way to financial freedom, in my opinion. Are you a dividend growth investor? Join us on this journey to financial freedom. Join the vested interest community. Hit that subscribe button. Hit that notification bell so you're notified whenever we put out any new content, and share with anyone you think that might find value in the content. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you tune back into the Stock Pick of the Day videos, and you have one you'd like me to cover, drop it down in the comment section and I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money, so never invest any amount. Not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.